Hello, and welcome back to Boni's Life. It's December 4th, 2025, and if you've taken a peek at the markets today, you'll know the crypto world is serving up its usual cocktail of thrilling highs and stomach-churning lows. Bitcoin is currently playing footsie with the $93,000 level, a tantalizing figure that keeps us all guessing. Is the next leg up to a new all-time high imminent, or are we just catching our breath before another slide? Meanwhile, Ethereum is holding its ground with remarkable resilience above $3,100, fueled by a flurry of activity in the DeFi and NFT spaces. The chatter on crypto Twitter, in the hallowed halls of financial institutions, and in our very own community is a mix of unbridled optimism and cautious pessimism. The age-old question echoes louder than ever. Are we staring down the barrel of a full-blown crypto winter? Or is this just a mild seasonal cold snap before the spring of another bull run? Well, whatever the weather, my advice is to grab your hot cocoa, get comfortable, and tune out the noise. Because today, we're going on a deep dive expedition to uncover the real opportunities that are not just surviving but thriving in this frosty market. We're not going to be swayed by the short-term FUD or the fleeting hype. Instead, we're going to focus on the fundamental pillars of value creation in this ecosystem. We're talking about the strategic gold rush of airdrops, the intricate financial machinery of liquidity pools, the passive income powerhouse of staking, and even a look at the modern-day digital prospector in the world of mining. This isn't just about making a quick buck. It's about understanding the technology, the economics, and the human psychology that drives this revolutionary industry forward. And as always, we won't be navigating this complex terrain alone. We'll be bringing in the heavy artillery, the insights, the commentary, and the hard-won wisdom from the sharpest minds in the game. We'll hear from the visionary developers who are writing the code of our decentralized future, the battle-hardened traders who can read the charts like a second language, the economists who are trying to make sense of it all, and yes, even the regulators who are finally, and I mean finally, starting to speak our language. So whether you're a seasoned degen who can recite the Ethereum white paper from memory, or you're just crypto curious and wondering what all the fuss is about, you are in exactly the right place. The next 30 minutes will be exciting, educational, intellectual, and, I promise, as accurate and convincing as humanly possible. Let's get into it. All right, let's kick things off with the one word that can make a grown crypto enthusiast weep with joy: airdrops. For anyone new to the party, an airdrop is essentially a marketing strategy where a new crypto project decides to distribute its tokens to the public for free. Yes, you heard that correctly. It's the digital equivalent of manna from heaven, a surprise inheritance from a long-lost crypto uncle you never knew you had. But let's be clear, this isn't just an act of blockchain-based benevolence. These projects are playing a very clever game. By giving away their tokens, they are instantly creating a widespread community of token holders, bootstrapping their network effects and generating a massive amount of buzz. And believe me, it's a game that is being played for very high stakes. We are talking about a multi-billion-dollar-a-year phenomenon that has spawned a whole sub-industry of so-called airdrop farmers. Dedicated individuals and teams who spend their days and often nights hunting for the next big token giveaway. The history of airdrops is littered with legendary tales. Who can forget the Uniswap airdrop back in 2020, where every user who had ever made a trade on the platform was gifted 400 UNI tokens? At its peak, that was worth over $18,000. Or the Ethereum name service, ENS airdrop, which rewarded early adopters with tokens that, for many, amounted to a five-figure payday. These events have become part of crypto folklore, cementing the idea that sometimes the best way to make money in this space is simply to be an active and curious participant. It's a powerful incentive model that rewards exploration and early adoption, a core tenet of the crypto ethos. But how do you position yourself for such a windfall in December 2025? It's certainly not as simple as just holding out your digital hand. The game has evolved. Projects have become much more sophisticated in their distribution methods. Most airdrops now require a significant level of interaction. This could involve using a project's testnet and providing valuable feedback, bridging assets to a new blockchain, providing liquidity to a fledgling decentralized exchange, or even just being an active contributing member of the Discord, or Telegram community. It's a merit-based system. Projects want to ensure their precious tokens land in the hands of people who are genuinely interested in their long-term success, not just mercenaries looking to dump them on the first day. As one prominent developer recently put it, we're not looking for users, we're looking for co-builders. The airdrop is just the first handshake. This shift has been accelerated by the ever-watchful eye of the regulators. The U.S. Securities and Exchange Commission (SEC), through its Project Crypto initiative, has made it clear that it is scrutinizing token distributions very closely. The concern is that some airdrops could be classified as unregistered securities offerings. This has forced projects to be far more creative and careful. They can't just spray and pray anymore. They need to demonstrate that the token distribution is fair, decentralized, and serves a genuine utility within the network. This regulatory pressure, while seen as a burden by some, is ultimately a positive development. It's professionalizing the space and weeding out the low-effort cash grabs. It means that while the days of getting rich from a completely random, no-strings-attached airdrop might be fading, the opportunities for dedicated, value-adding participants are more significant and more legitimate than ever. So, what's the playbook for a successful airdrop hunter in December 2025? It boils down to a single crucial principle: due diligence. You must become a digital detective. Your first step is to identify promising pre-token projects. Look for projects backed by reputable venture capitalists with a public-facing team of experienced developers, a clear and ambitious roadmap, and a vibrant, engaged community. Don't just chase the projects with the most hype on Twitter. The real gems are often the ones being built quietly and diligently in the background. Once you've identified a target, immerse yourself in their ecosystem. Use their products, break them, provide feedback, write tutorials, help new users in the Discord. Become the user that every project dreams of having. And it should go without saying, but I'll say it anyway. Be relentlessly vigilant about security. For every legitimate airdrop, there are 100 scams. Never ever share your private keys. Never sign a transaction you don't understand. Use a banner wallet for interacting with new unaudited protocols. Remember the golden rule: if a project asks you to send them crypto to receive an airdrop, it is a scam. 100% of the time. The opportunities are vast, but the crypto seas are full of pirates. Be smart, be safe, and be selective. The treasure is out there, but it won't just fall into your lap. You have to earn it. Next, let's wade into the deep end of the pool, the liquidity pool. This is the beating heart of decentralized finance, or DeFi. If you've ever marveled at the ability to swap one obscure crypto asset for another on a decentralized exchange, DEX, like Uniswap or PancakeSwap, you have a liquidity pool to thank. Think of it as a community-owned pot of money. Instead of a traditional exchange that uses a complex order book to match buyers and sellers, a DEX uses a pool of 2 or more tokens locked in a smart contract. This automated market maker, or AMM, allows for instant permissionless trading. And here's the beautiful part. You can be the bank. By depositing a pair of assets into a liquidity pool, you become a liquidity provider, or LP. In return for your service, you earn a percentage of the trading fees generated every time someone uses that pool. This, my friends, is the essence of yield farming, putting your dormant crypto assets to work to harvest a steady stream of passive income. And when I say the yields can be juicy, I'm not exaggerating. In the heady days of DeFi summer back in 2020, we saw annual percentage yields, APYs, that reached into the thousands. It was a veritable Cambrian explosion of financial innovation. While the market has matured and those insane yields have become rarer, the opportunities are still vastly more attractive than anything you'll find in the legacy financial system. We're still seeing double-digit and sometimes triple-digit APYs on a wide range of platforms. And you knew there was a but coming. With great yield comes great responsibility. Or, to be more precise, great risk. The boogeyman of the liquidity pool is a sneaky little concept called impermanent loss. Let me try to break it down with an analogy. Imagine you're providing liquidity for a pool of Bitcoin and Ethereum. You deposit an equal value of both. Now, if the price of Bitcoin suddenly moons while Ethereum stays flat, the smart contract will automatically rebalance your holdings to maintain that 50-50 value split. This means it will sell some of your precious Bitcoin to buy more Ethereum. If you were to withdraw your funds at that moment, you'd find you have less Bitcoin and more Ethereum than you started with. The total value of your holdings might be less than if you had simply held the two assets separately in your wallet. That difference is impermanent loss. It's impermanent because if the prices return to their original ratio, the loss disappears. But in the volatile world of crypto, that's a big if. It's the silent killer that has liquidated many an aspiring yield farmer. But don't let the fear of impermanent loss paralyze you. The DeFi space is evolving at a breakneck pace. As the great Vitalik Buterin himself proclaimed in a recent interview, the difference between DeFi in 2025 and the early experimental era of 2020 is night and day. We're seeing a level of sophistication and security that is beginning to rival traditional financial institutions. We now have a plethora of innovative solutions designed to mitigate these risks. There are platforms that specialize in single-sided liquidity provision, concentrated liquidity strategies that allow you to be more capital efficient, and even protocols that offer explicit impermanent loss protection. The key is to be strategic. Don't just blindly ape into the pool with the most eye-popping APY. As one grizzled DeFi veteran told me, the APY is the bait. You have to look at the hook. Understand the assets in the pool. Providing liquidity for two stablecoins, for example, carries a much lower risk of impermanent loss than a pool with a highly volatile, unproven altcoin. Read the documentation, understand the smart contract risk, and as always, diversify your bets. The world of yield farming can be a treacherous and unforgiving jungle, but for those who learn to navigate it with skill and caution, the rewards can be truly life-changing. Now, let's shift our focus to another cornerstone of the modern crypto economy: staking. If liquidity pools are the bustling marketplaces of DeFi, then staking is the bedrock upon which these new digital nations are built. In the simplest terms, staking is the process of actively participating in the validation of transactions on a proof-of-stake (POS) blockchain. By locking up or staking your cryptocurrency, you are helping to secure the network. In return for this vital service, the network rewards you with more of that cryptocurrency. It's a beautifully elegant system that aligns the incentives of the token holders with the security and integrity of the network. It's like being a shareholder in a company who also gets paid to be on the board of directors. And since Ethereum's historic transition to proof of stake, an event known as the merge, staking has exploded into the mainstream consciousness. The staking landscape of December 2025, however, is a far more complex and nuanced beast than it was just a few years ago. The most noticeable trend is the gradual decline in yields. As more and more people stake their assets, the rewards are spread more thinly. The days of earning a consistent 10 to 20% APY on a major network like Ethereum are, for the most part, a thing of the past. We're now seeing average yields hovering around the 2.5% to 5% mark. But that doesn't mean the opportunity has vanished. Far from it. In fact, the innovation in the staking space has never been more exciting. The most significant development has been the rise of liquid staking. Traditionally, when you staked your tokens, they were locked up and illiquid. You couldn't use them for anything else. Liquid staking protocols have changed the game. They allow you to stake your tokens and, in return, receive a derivative token that represents your staked position. This derivative token can then be freely traded, used as collateral in lending protocols, or deployed in other yield farming strategies. It's a powerful innovation that unlocks a huge amount of previously dormant capital and adds a whole new layer of composability to the DeFi ecosystem. But the biggest story in the staking world right now, without a doubt, is the thunderous arrival of institutional players. With the regulatory green light for staked Ethereum exchange-traded funds, ETFs, Wall Street giants like BlackRock and Van Eck are now major players in the staking game. This is a classic double-edged sword. On one hand, it's a massive vote of confidence in the technology. It brings a tidal wave of new capital and legitimacy to the space. On the other hand, it raises profound and uncomfortable questions about the potential for centralization. As Vitalik Buterin has astutely warned, there is a very real risk of the Ethereum network being captured by a handful of powerful Wall Street firms. If a few large entities control a significant portion of the staked ETH, they could theoretically collude to censor transactions or otherwise compromise the neutrality of the network. This is a battle for the very soul of Ethereum, and it's a conversation that will dominate the discourse for years to come. For the individual investor, however, the path is still clear. The opportunities to earn a reliable passive income through staking are abundant. It's just a matter of being smart about how and where you stake. Do you run your own validator node? Do you use a centralized exchange? Or do you embrace the world of decentralized liquid staking? Each path has its own unique set of risks and rewards, from the technical challenge of running your own hardware to the smart contract risk inherent in liquid staking protocols. The choice is yours. And finally, let's get our hands dirty and talk about the original crypto hustle, the one that started it all: mining. For many people, the image of a Bitcoin miner is still that of a lone tech-savvy individual in their basement, with a rack of humming computers, literally printing digital gold. It's a powerful and romantic notion. But the reality of cryptocurrency mining in December 2025 is a world away from that solitary pursuit. The days of profitably mining Bitcoin on your home computer's CPU or even a high-end gaming GPU are a distant, almost mythical memory. Today, Bitcoin mining is a ruthless, hyper-competitive industrial-scale enterprise. It's a game of massive economies of scale, played by publicly traded corporations with vast data centers, sophisticated cooling systems, and direct access to wholesale energy markets. And it's a tough game to be in right now. According to a recent, widely circulated report from the analysts at JP Morgan, the profitability of Bitcoin mining has been in a steady decline for the fourth consecutive month. The primary culprits are a familiar pair of adversaries for any miner: the ever-increasing cost of electricity and the relentless upward march of the mining difficulty. The Bitcoin network is designed to produce a new block, on average, every 10 minutes. As more and more computing power, or hash rate, joins the network, the protocol automatically adjusts the difficulty of the mathematical puzzle that miners are competing to solve. This ensures the block time remains consistent, but for the individual miner, it means they are getting a smaller and smaller slice of the same pie. To be a successful Bitcoin miner in 2025, you need two things above all else: access to extremely cheap, preferably renewable, energy, and a fleet of the latest and greatest application-specific integrated circuit (ASIC) miners. And even with those advantages, the profit margins are becoming razor-thin. But does that mean the dream of mining is dead for the little guy? Not entirely. It has just evolved. We're seeing a significant rise in the popularity of cloud mining services. These platforms allow you to essentially rent hashing power from a large-scale mining operation without the need to purchase and maintain your own expensive hardware. It's a way to get exposure to mining revenues with a much lower barrier to entry. However, this path is fraught with its own perils. The cloud mining space has historically been rife with scams and unprofitable contracts, so extreme caution and due diligence are paramount. Furthermore, while Bitcoin may be out of reach for the hobbyist miner, there are still a multitude of other proof-of-work coins that can be profitably mined with a good GPU setup. Projects in the realms of privacy coins, decentralized computing, and gaming are still fertile ground for the small-scale miner. It's a matter of doing your research, finding a niche, and understanding the specific economics of the coin you choose to mine. Before you rush to eBay to buy a dozen GPUs, however, it's crucial to have a frank discussion about the risks. The upfront capital expenditure for a decent mining rig can be substantial, and the hardware can become obsolete with alarming speed. And then there is the unavoidable and highly contentious issue of the environmental impact. Bitcoin mining, in particular, is a notoriously energy-intensive process. While the industry is making significant strides in utilizing renewable energy sources, the narrative of crypto being an environmental disaster is a powerful one, and it's a topic that is attracting increasing scrutiny from regulators and the general public. As one economist from a leading European university noted, the long-term social license for proof-of-work mining will depend entirely on its ability to transition to 100% renewable energy. The industry is at a crossroads. So, while the dream of minting your own digital money is still very much alive, It's a dream that now comes with a hefty price tag, a complex set of risks, and a significant degree of social and environmental responsibility. As with all things in this space, it remains a high-risk, high-reward endeavor. Now, no discussion of crypto opportunities in 2025 would be complete without taking the temperature of the regulatory climate. For years, the crypto industry has existed in a state of perpetual regulatory ambiguity, a kind of Wild West where innovation outpaced legislation at every turn. This has been both a blessing and a curse. It allowed for a period of explosive, permissionless growth, but it also created a climate of uncertainty that has kept many institutional and retail investors on the sidelines. But the winds of change are blowing. We are in the midst of a global concerted effort from governments and financial institutions to bring some semblance of order to the chaos. And while the word regulation might still send a shiver down the spine of the most ardent crypto purist, the emerging consensus is that this is not just necessary but ultimately beneficial for the long-term health of the industry. In the United States, the change in tone has been palpable. The SEC's landmark Project Crypto initiative, launched earlier this year, represents a significant shift from a posture of enforcement first to one of proactive engagement. The goal, as stated by the SEC chairman, is to modernize the securities laws to foster capital formation in the digital asset markets and enable innovation to flourish within a clear regulatory framework. We've seen this in action with the approval of several spot Bitcoin and staked Ethereum ETFs, a move that has unlocked a torrent of institutional capital. We've also seen the IRS issue much-needed guidance on the tax treatment of staking rewards and other complex DeFi transactions. And perhaps most significantly, the FDIC and the OCC have both issued statements clarifying that FDIC-supervised banks can, in fact, engage in a range of permissible crypto-related activities, including custody and asset management. As a senior partner at a major financial law firm commented, the regulatory fog is finally starting to lift. We're moving from a period of uncertainty to a period of clarity, and that is incredibly bullish for the entire industry. This trend is not confined to the United States. The Financial Stability Board, FSB, and the International Monetary Fund, IMF, are both in the advanced stages of developing comprehensive global regulatory frameworks for crypto assets. Their focus is on creating a level playing field, managing systemic risk, and protecting consumers, while still allowing for the transformative potential of the technology to be realized. The IMF's most recent crypto assets monitor, published in October, even noted the improved risk-adjusted returns of Bitcoin in 2025 amid optimism regarding regulatory developments. The message is clear. The world's most powerful financial institutions are no longer viewing crypto as a niche, speculative asset class, but as an integral and permanent part of the global financial system. So, what does this regulatory thaw mean for you, the average crypto investor? On a practical level, it means that the days of operating in a lawless gray area are definitively over. You must be more diligent than ever about understanding the legal and tax implications of your activities. But on a more profound level, it means that you can invest and participate in this ecosystem with a far greater degree of confidence. The rules of the road are being written, the guardrails are being put in place, and the industry is being held to a higher standard. The crypto world is, for lack of a better term, growing up. And that maturity is the fertile ground from which the next generation of world-changing applications and opportunities will grow. So, there you have it, a whirlwind, yet hopefully comprehensive tour of the crypto landscape as we stand at the precipice of 2026. We've sifted through the digital gold pans for airdrops, we've swum in the deep and sometimes turbulent waters of liquidity pools, we've laid a foundation on the bedrock of staking, and we've explored the industrial frontier of mining. The inescapable conclusion is that despite the market's volatility, despite the fear-mongering headlines, and despite the complexity, the opportunities in the crypto space are not just alive and well. They are more diverse, more sophisticated, and more accessible than ever before. But let's be abundantly clear. This is not a get-rich-quick scheme. The crypto world is not for the faint of heart, the impatient, or the intellectually lazy. It is a volatile, unpredictable, and often unforgiving arena. As we've discussed, With every opportunity comes a commensurate level of risk. The specter of impermanent loss, the peril of smart contract exploits, the sting of regulatory crackdowns, and the simple, brutal reality of market cycles are ever-present dangers. The key to survival and indeed to success is to approach this space with a potent combination of intellectual curiosity, healthy skepticism, and unwavering discipline. Do your own research, read the white papers, engage with the communities, understand the technology, and never ever invest more than you are willing to see go to zero. As the legendary investor Benjamin Graham once said, the investor's chief problem, and even his worst enemy, is likely to be himself. But for those who are willing to put in the work, for those who are willing to learn, to adapt, and to persevere through the inevitable cycles of boom and bust, the rewards can be truly transformative. We are living through a period of profound technological and financial revolution. The future of money, of finance, of art, of governance, and of the internet itself is being built block by block before our very eyes. And every single one of us has the opportunity to be a part of it. So as we head into the new year, let's do so with our eyes wide open, our minds sharp, and our spirits high. The new frontier is here. It's wild, it's challenging, and it's waiting for you. Please be aware that I only trade for myself exclusively and do not trade for anyone. Hence, I will never ask you for money or to join in any trades. I only ask you to subscribe to my channel, listen to me, and conduct your own research. Please have a trading strategy and use your own trading plan for all your trades. Always conduct your own final research and make your own decisions. I want to have a prosperous community, avoid scams, rug pulls, and get-rich-quick schemes. Trading is a science, not gambling. Trade carefully, be disciplined, and trade intelligently. Thank you for tuning in to Boni's Life. Until next time, stay curious, stay informed, and most importantly, stay safe out there.